Good afternoon, 1 o'clock Eastern time anyway. This is David Dietze. I'm going to be joined here by Donna St.Amant, and we're going to be talking about some of the most important questions for retired investors today. Now, this is a webinar. Webinars are supposed to be interactive, and the way this is going to work is we're setting aside time at the end of our webinar to answer your questions. So as you're watching, if something comes up that you want to know more about, we invite you to type out a question. It will come into us, and we're going to field those questions at the end. One other kind of fun element of the webinar today is we've got a poll going, which basically asks you where you think the market's going to be over the next 10 years. We invite you to make your selections there, and we're going to share the results with you at the end. We are so fortunate to have Donna as part of the Point View team. Donna has spent her entire working career in the financial services industry, being at such big names as Bank of America and Merrill Lynch, portfolio manager here. She has received her MBA from Columbia and her bachelor's degree from Villanova. Without any further ado, I'm going to turn the presentation over to Donna.
Thank you, David. Before we get started on the big important question for today, we're just would like to give you some background on Point View. We are a fee-only SEC-registered investment advisor. We're based here in Summit, New Jersey. We're affiliated with PPAC Private Wealth with $5.8 billion under management, with locations throughout New Jersey and offices in Delaware and Florida. What we provide is customized investment management services and holistic financial planning. We work with individuals, work with families, and small institutions. So we manage our accounts, and we customize portfolios for each client that we rebalance monthly. Now, while taxes should never solely dictate the investment decision, there are more efficient ways to structure your portfolio to manage gains and losses. So that's a top priority for us. So we use primarily individual stocks and bonds that allows us flexibility to manage in the most tax efficient way possible. In terms of asset size, our relationship minimum is $500,000. That includes family accounts. We have an annual 1% management fee. That includes all of our investment management services as well as all financial planning. And clients can save versus also having to pay underlying fees on mutual funds or ETFs that may be used by other advisors. Alternatively, you could take advantage of just our financial planning analysis for a flat fee, and that's credited dollar for dollar against our management fees if a client later chooses to sign on with us. And finally, as a measure of security and comfort for our clients, all assets that we manage are custodied at Fidelity, and clients can log on to the Fidelity website to view their accounts. So this is a snapshot of our team here at Point View. Aside from David and myself, we have Claire Toth, who heads our financial planning group. And then there are 3 portfolio managers. In addition to myself, we have Fritz Schoenhut and Elaine Phipps. We have 3 client service representatives, Annette Tucker, Jeanette Carey, and Chris Gilmartin. And then Marcela Garcia runs our office operations. We would invite you to log on to our website. You can read full bios on any members of our team. Just a couple of points. Point View has received some national recognition for its efforts. CNBC has ranked Point View as among the top advisors in the country. Most recently, in 2019, Investopedia, we were on their top 100 list. And Financial Advisor Magazine has also named us a top advisor in 2018. So now to move on to today's topic, I'm going to have David kick it off with the very important question. The first question is, how much can I withdraw from my portfolio? David?
Hey, thank you so much, Donna. So the number one question that we get from our clients is, I'm giving you some money to manage, or here's my nest egg. What can I responsibly spend from it? Well, that of course begs some great questions like, well, how long do you want the portfolio to last? You can empty it all out in 1 year, but that doesn't make any sense. So probably what we'd like to do is try and, almost in a very mathematical way, figure out what is a safe withdrawal rate. And we start from the concept that you want it to last almost into perpetuity. So what you really want to do is figure out how much your portfolio can generate over the long haul. But of course, we always tell our clients, do you want to preserve the real value of your nest egg? So what exactly does that mean? That means if you make 6% each year and you take 6% out each year, then the value of your portfolio is going to fall because it's going to stay the same in terms of nominal terms, but inflation is going to erode the actual value. So what we suggest is perhaps whatever you're going to take out, hold a couple percent back for whatever you feel inflation might be. And of course, the other thing, of course, is in terms of what your portfolio can generate is how you've allocated that portfolio. The various asset classes, that would be stocks, bonds, and cash are the three big ones, are all going to have different projected long-term returns. Once you figure out how much your portfolio you're going to allocate to each one, then you can come up with a blended potential return, subtract some inflation, and there's what you can safely take out of your portfolio on an annual basis. Okay, so now you've got a question, how much should I have in stocks, how much should I have in bonds, and how much should I have in cash? And really, that depends on your goals, and that depends on your risk tolerance. Historically, stocks have outperformed bonds by about 2 to 1. But on the other hand, stocks are far more volatile, and potential drawdowns can be as much as half of the value of the stock allocation of the portfolio. So you have to, as Peter Lynch once said, figure out, do you want to sleep well at night or eat well during the day? We, of course, typically suggest a blend. But how that blend is constructed, probably the more the more financially solid you are, the lower your debt, the larger your nest egg relative to your liabilities, whether they're fixed or maybe contingent, like perhaps funding some college educations along the road, the more risk you analytically can take. But on the other hand, we all know the proverbial person with a very huge nest egg who can't get a wink of sleep if they lose a penny. And obviously it's important to take those psychological factors into consideration and weigh that against what analytically a family or a person can tolerate in terms of risk volatility. So that's things that we consider when coming up with those questions. The next question is how I can minimize taxes on my portfolio, and I'm going to turn it over to Donna to start talking about this one.
Okay, great. Thanks, David. So all investors are concerned about taxes, and that does not change when you're in the retirement phase of investment management. So how can I minimize taxes on my portfolio? So first, we would recommend that you put stocks in your taxable account and bonds in your tax-sheltered accounts. And the reason for this is tax-sheltered accounts, all of the money is coming out taxed at your highest ordinary income tax rate. Whereas in the taxable account, there are preferential lower rates for capital gains, for dividends, and these are only available on equities that are held in your taxable account. So to take advantage of this setup, that's why we suggest stocks in taxable and fixed income in tax sheltered. So for example, if you have a 70% equity allocation, you would start building your equities in the taxable account. And then if you reached your 70%, you still had cash to invest in the taxable, then you would go look to fixed income. And for that, we would suggest using tax-exempt bonds for the taxable account. If, on the other hand, you have exhausted all of your taxable money and you still have more equity to invest to reach your 70% asset allocation, then you would look to put some equities in your tax-sheltered accounts. However, all of these accounts listed here, 529s, Roths, traditional IRAs, yes, they're all tax sheltered, but they're different in that the money coming out of the 529 and coming out of the Roth comes out tax free. So when looking to put some equities in the tax sheltered accounts, we would recommend first going with the 529s and Roth, and then with any extra investing equities in the traditional IRAs. Take advantage of Roth accounts. So it's very helpful in retirement to have different buckets of money to when you're going to take income. So it gives you more flexibility with regard to taxes. If you have some of your savings in traditional retirement accounts, those are coming out, you pay taxes. But in addition to have also savings in a Roth account, so that when that comes out, you're not paying any taxes. It gives you much more flexibility. So for our clients, we're creating sort of a customized mutual fund, I guess you could say, for each client. We buy individual stocks across a different sectors, well diversified, well balanced. But the key thing is that they're unbundled. So we could pick and choose among the stocks when we want to make sales and choose something that has the lowest gain. Or if we sell something with a higher gain, we can offset it with a loss. As opposed to if you're in a regular mutual fund, a traditional mutual fund, you just have to accept what the mutual fund manager is trading. And then at age 70 and a half, you will have to take your minimum required distribution from your IRA. In this case, we would suggest only take the minimum that's required. If you're taking income from your accounts and you need more than your MRD, we would then look to other sources like your taxable account or a Roth account. And again, Roths, another benefit of the Roth here, avoid triggering capital gains. Everything that's growing in the Roth is growing tax-free and comes out tax-free. So that's another benefit there. David, anything to add on taxes?
I think you covered it extremely well. This is the challenge, of course, of investing for private clients. It's not what you make, but it's what you make after taxes. And that's why we dedicate ourselves every day to making sure that that tax bite is minimized to the extent possible.
Okay, so the next question, should I roll out my 401k and pension? To this, we would absolutely say yes. Rolling your 401k, you would roll it into an IRA in your individual name. This allows you to consolidate accounts, makes for much more streamlined management of the investments. It also helps you when you're managing your MRDs. It simplifies it because you need to look at all of your IRAs and 401ks when calculating your MRD. If you leave it in a 401k, the MRD has to be taken specifically from that account, from that 401k plan. So again, it simplifies it. The IRA provides you with many more investment choices. You're not limited to what's offered in the 401k plan. You also may be tied to an investment manager within that 401k plan. So always a good idea. Similar to roll out a pension. Sometimes pensions have maybe a fixed low return. So rolling it out, you have all the benefits we just discussed, the opportunity to earn higher returns, and you have flexibility and the ability to pass on to the next generation. So we mentioned the MRDs a bit, but to talk more specifically about handling your MRD in a tax efficient way and getting the most out of your accounts, you can use your MRD for charitable gifting. So if you're typically giving to charity each year, you can take your MRD or a portion of it and send it directly to the charity so that you don't have to pay the ordinary income taxes. We suggest taking it as late in the year as possible. The reason for this is so that your money simply can grow tax-free for as long as possible. And the third point here is very important, is to make sure that you've counted all of your IRAs. So if you have many IRAs, they're held at different financial institutions, you have to be sure to include them all when you're calculating your MRD. You do not have to take the MRDs from each account individually. You can take the entire amount from one account, but it's critical that you do it properly because, as we say here, omission is very costly. If you forget to take your MRD or you don't take enough, the penalty is half the amount of the MRD, which is one of the highest penalties in the tax code. So a very important point there. Unless you have something to add, David, I'm going to send it back to you to talk about gifting.
Great. Thank you so much, Donna. So, gifting here. So another question that we get all the time is, should I share my money with my kids, maybe my grandkids? And of course, that's a very personal decision. But if you are going to go in that direction, we often encourage you to structure in such a way that you're getting the next generation off the good habits. So one thing we like to see is to condition your gift that it be put into one of these tax sheltered accounts. Why is that? It will be less likely to be spent on something frivolous and will be more likely to grow on a tax deferred basis for a long time. So you're encouraging savings and good habits. The other thing we like to see, of course, is gifts that go into 529s. What are 529s? 529s are basically Roth type of accounts where the money grows tax sheltered, and then if given for a qualified educational purposes, which basically means for college or up to $10,000 a year for private school, it comes out tax-free like a Roth. So that's a great opportunity to make sure that your gift is targeted to a great purpose. People sometimes say, should I give cash or should I give stock? Well, in a gifting situation, someone's going to have to pay the unrealized gain on the stock. If you give them the stock, then the next generation will ultimately be tagged with that gain. If you sell the stock and then give the cash, you're tagged with the gain. So probably we think that it makes the most sense probably to give cash, because that way you maximize the amount of actual gift getting into the hands of the next generation. People say, what's the correct amount? Well, who knows for sure? That depends on your situation, the situation of the next generation. But a lot of people look to give the maximum amount per year that they can give, which is not included in any kind of gift tax return. That would be $15,000 per beneficiary per donor. So therefore, if you had, let's say, one child and two parents, you could give $30,000 each year to that child without having to file any kind of gift tax return. Now, you could give more than that and not have to pay gift tax as long as you don't go above and beyond the total amount you can give at the time of death, which right now is about over $11 million per person. So you could give more without having to pay tax, but you would have to file a gift tax return, which a lot of people do not want to do. A lot of people say, what's the best way to give to my favorite charity? Well, probably the worst way to do it is just to turn over cash. And here's why. You really want to do gifting to charities on a tax leverage basis. The one we like best, those who are 70 and a half and older, instead of taking out their minimum required distribution from their IRA, piling that into income, and then giving the gift, you don't usually get as good a tax benefit. And here's why. Because the MRD is definitely going to be part of your income, but you may or may not get a deduction for the charitable gift. Well, why maybe not? Here's why. Because every couple gets $24,000 standard deduction, and state and local taxes are capped at 10. So unless you have other deductions, which would primarily be a mortgage, unless you're giving more than $14,000, then you're not going to get any deduction for the charitable gift because it doesn't get above that standard deduction level. So we like directing the broker to give gift to charity right as part of the MRD. If, however, you're under 70 and a half or otherwise don't have MRDs, the next best way to go is to give appreciated stock. Now, why does that make sense? Because if, let's say, you bought a stock and it's doubled, if you sell it, you have to pay taxes on the gain, and then whatever's left you can give to charity. If you give them the actual stock certificate itself, you get a deduction for the full value of the stock, and you bypass having to pay any taxes on that unrealized gain. So that's good. Another thing we recommend is using charitable gift accounts, because here you can put into the account that appreciated stock, get an immediate deduction for this whole amount, but then you can parcel out the actual gifts from the account to the actual charities when you're ready to do that in the amounts you want to do it. Very similar to like a bill pay that you might see at a bank. So we think those give you tremendous flexibility. I mean, here's the example. I want to give $50 to the United Way, and I have, shares of IBM that are worth $150. Well, you can't just give a fractional portion of IBM, but if you were to put the IBM into one of those accounts, then you could direct just $50 going out to the United Way. You can break it up very easily. Obviously, bunching your gifts could make sense. Let's say you're only giving $10,000 per year to a charity that doesn't get you above the standard deduction. Maybe take the next 5 years, $50,000, give it 1 year. Then a lot is going to be over that standard deduction amount, and you get a better tax outcome there. And again, as we pointed out, don't use cash. A lot of people come to us and say, well, why would I use an advisor? Why wouldn't I just use an index fund? Well, we definitely agree that low fees are always a good idea, but like a lot of things in life, the cost is never necessarily the most important aspect of anything you buy. You want to have the right portfolio. Here, of course, when you say index fund, you could be talking about a large cap index fund like the S&P 500, or you could have a small cap one, a mid cap one, you could have an international one, an emerging market one. So it does beg the question of which index funds and how do you put them together? And that's critical, particularly where we see some index trading with much higher dividend yields than others. And then, of course, you still have the question, do I want to put everything into a stock index fund or have a bond index fund or other types of asset class index funds? How do you put those together? So that's an extra complication. Another reason why we're negative on index funds is take the S&P 500, it's 500 different stocks. They're not all of equal weighting in the index. In fact, they're weighted depending on their value in the marketplace, the so-called market cap. So you have a very few stocks at the very top which are pushing around the index, and the stocks at the bottom have almost no weighting. So if you really like the stocks at the top, that's great. But if you think about it, most of the stocks at the top are there because they've done very well. Their valuation can be very high. Indeed, we've seen that buying stocks at the lower part of the S&P 500 is a more profitable strategy than just sticking with the large ones. Of course, index funds are jointly owned by all the holders out there. We haven't seen it in recent years, but if there was some sort of investor panic and everyone wanted to redeem their index fund, you may want to stay the course. Your fellow fund holders are yanking the money out. That's going to create all sorts of volatility and problems for that fund. So at the end of the day, we don't think having a single index fund makes as much sense as having a diversified portfolio of 40 to 50 stocks where you control the selection and you control the turnover for tax purposes. Often people say, well, if I am going to go in the fund direction, do I do an exchange traded fund or a mutual fund? Exchange traded fund is basically a mutual fund in a package so it can trade all day on the New York Stock Exchange. Let's be clear here, for a substantial portfolio, we think you're better off having individual holdings. That way you get focus, transparency, can sidestep fees. But between the two, we'd prefer conventional funds. Often with an ETF, there's uncertainty as to whether the price you're paying is equivalent to the internal value of the holdings. People often say, Dave, isn't an annuity the way to go? Well, generally we say absolutely not. With the annuity, there's high embedded fees. There's back-end fees called surrender charges if you want to go in a different direction. As a result, the returns are poor. Like a 401k at an employer, you have limited investment choices. To the extent an insurance company is backing up that annuity, that raises questions as to their health, and we've seen problems with insurance companies in the past. To the extent you're settling for a fixed payout for retirement, that's going to be vulnerable to inflation. Let's say you need to change course, there's a medical issue, or you want to help fund a child or grandchild's business. You've got it's very inflexible. You don't have the liquidity. When you pass away, it typically is done. So you're leaving nothing for the next generation. And the taxation of the payments coming out are not tax advantage like a return on a stock, but rather just ordinary income, so inefficient. Now, people often come to me, Dave, what you're doing is great. I just wish I had done it 20 years ago. Does it still make sense to get into the stock game today? And I mean, we tell people, yeah, it's like planting a tree. The best time to have done it is 20 years ago, but the next best time is really today. But it does all depend on your time horizon. If you have money that you need to pay the rent next month, or a big deposit on school in 2 months, yeah, stay very liquid. Don't get into stocks. But if you're talking about saving for a long-term goal, for example, your retirement, absolutely. Historically, stocks have outperformed, and there's really no reason to suspect that won't be the case over a long period. But of course, you do want to see what you already have. You don't want to get overweighted any one asset class. In terms of valuations today, I think stocks look very compelling relative to bonds. Why do I say that? Because the yield on stocks is about 2%, and the yield on the 10-year treasury about 1.7. Historically, yields on stocks have gone up 5 to 10% per year. So over the next 10 years, you could have a yield on the amount invested today that's approaching 4, 5, 6%, while you're still stuck at that 1.7 on bonds. So we think that from relative to bonds, stocks look very attractive going forward here. Obviously, there's a lot of near-term things that we're looking at, including corporate earnings, health of the economy. We've seen strong GDPs, but we have to monitor that quite carefully. The Federal Reserve, of course, seems to be on a rate-cutting path, and traditionally that has provided a tailwind for stocks. Of course, we're all on pins and needles in terms of the latest trade talks with China and other areas of the world. That can play into the near-term prospects for volatility. There could, of course, be an infrastructure deal enacted by Congress that would give a spur to the economy. And, of course, the all-important 2020 elections. The only thing I'll say about elections is over the long haul, you're going to see a lot of different administrations, a lot of different elections. So we would never place too much emphasis on any one administration, any one election, but rather take the long-term view. Many people say, well, gee, so you said stocks are a much better deal than bonds. Why should I have bonds at all? Well, I think it does still make sense to keep a commitment to fixed income. Why? If you have high quality fixed income, that's going to be the types of bonds that people are going to be rushing to if the market gets very volatile. And of course, we know we've seen volatility in the past. We know we're going to see it in the future. People say, yeah, but the yield is so low. Does it really make sense? Well, I would analogize it to getting an insurance policy on your car, your car insurance. If they doubled the rate, would you say, gee, I'm going to try and drive without having any insurance behind me? Of course not. You can't take that risk. So I would liken a commitment to bonds to having an insurance policy on the stock portion of the portfolio, and that always makes sense. To lower risk, don't have your maturities go out too far. That could be susceptible to potential inflation. And you might ladder the maturity so you have some that mature near term, some midterm, and some go out maybe 10 to 11 years, and that can help reduce volatility. So what I'd like to do now is to invite Donna to come back in here. And what we'd like to do is address some of the questions that have been coming in so far.
Okay, great. Am I back on here?
You're back on, Donna. You want to take the first question?
Yeah, sure. How do the IRA and 401k rules, are they different if I work in retirement? So a couple of points here. If you're older than 70 and a half, you can no longer contribute to an IRA. However, there is no age restriction on contributing to a 401k. So if you're still working, you can continue to contribute to your retirement savings through that company's 401k plan. You still must take your minimum required distribution, even if you are working. However, you can delay tapping into the 401k of your company if you're still working. So that's one way to delay, taking some distributions. And Roths, there is no minimum required. There's nothing required to distribute from a Roth. So, David, do you want to add anything to that?
No, I think you've got it absolutely right. One question that comes up a lot, and we're seeing here today, is, quote, I've heard I should have guaranteed income, Social Security plus fixed annuity equal to my necessary expenses, housing, food, medical insurance. Why not buy a non-variable annuity to bridge the difference between Social Security and those expenses? And we like the idea of variable, which means that having exposure to equities and so forth in a non-fixed investment so that you have the potential for higher returns. Having said that, why we don't want a non-variable annuity is we don't want to be burdened down with the high fees that typically attach to that. We don't want to be limited to the choices that would be available in one particular annuity provider's portfolio. And of course, the future is always uncertain, as they say. It's hard to look around the corner, and you never know when you might want to move in a different direction. So you want liquidity, and typically annuities do not provide liquidity except potentially at a very high cost to extricate oneself. So we would prefer the portion that you want to have growth in and to handle your discretionary expenses to be in a well-managed non-bundled portfolio of stocks and bonds that provides liquidity, all the choices under the sun in terms of investment choices, and low cost.
There's a question here. Should I consider buying bonds with longer maturities to get more yield? A couple of points there. We like to buy bonds. We would consider going out to about 10 years to get some extra yield. Yes, we think that's a good idea. Beyond 10 years, 10 or 11 years, we don't really know if you're paid to take on that additional risk. But we would not, as with anything, we want to be diversified, and we think the best way to invest the fixed income is to spread the maturities out from about 5 to 10 years so that you do continually have bonds maturing, rolling off, allowing you to reinvest at new rates. The other point I would make is, in a well-diversified portfolio, we're really looking to get most of the earnings from the equity portion of the portfolio, and the fixed income side is really to manage the risk and to limit the volatility. So we're not looking to really grab a ton of yield in the fixed income space. But yes, I think it is a good idea to go from 5 to 10 years.
Great. Thank you, Donna. So I'm seeing a question now, what would be a better investment, a CD paying 2% or a bond paying the same? Well, I preface my remarks saying that's a tough choice because a lot of us have been through the 70s. We've seen inflation at much higher levels, and to lock in at 2% when inflation could be much north of 2% doesn't seem like a great way to preserve capital. But having said that, I think the first thing you want to look at is the tax treatment of any type of fixed income investment. So if you want to be very conservative and be in fixed income, we'd look at tax exempt fixed income because quite frankly, if you can get 1.9% and pay no tax, that's going to be a better after-tax deal than getting 2% or even 2.2% and having it fully taxed by federal and wherever in the income tax authorities of whatever state or in local jurisdiction you live in. Having said that, between the CD and bond, typically the bond is going to be the better deal because there's going to be liquidity without penalty. So CDs, typically, if you need the money before the end of the term, you're going to forfeit some of the interest. That's not a great thing. Well, a bond could be sold at any time. The problem, however, is bonds typically are most liquid when bought in $25,000 chunks or more. So that if you're talking about $2,500 instead of $25,000, you're kind of frozen out of buying a bond versus a CD. But we still think you can buy bonds effectively with that amount by getting into a bond fund, which is going to be managed by some sort of a fund company. They're going to hold the bonds and then you can get in and out, hopefully at net asset value without cost, and take advantage of the improved liquidity versus a CD. Thank you. Donna, you got any questions you want to answer there?
I think we're good right now.
I see one more question, which is whether a BlackRock mutual fund with very low expenses might be a better place to keep one's money than rolling out from the 401k. Well, obviously, you can only roll out after you leave your job. And why might you still roll out even if you have a very attractive mutual fund? I think a couple of reasons. One, of course, is that would give you even more investment choices. And although the particular fund may be a low expense fund, if you get directly into individual stocks and bonds, you're not paying any fees at all. So that's always a little bit better. There's nothing like knowing what it is you own. And we get so frustrated with some of these funds. We say, well, what are the top 10 holdings? They say, well, as of March 31, Mr. Dietze, here's our top 10 holdings. Well, here we are in September. Say, well, you have a great record. We're impressed. Are the people who created that record still intact? Oh, Mr. Dietze, so this team managed. Well, are the same members on the team still there? Well, we can't tell you that. That's proprietary. So it's always difficult to look back and assume, as they say, past performance is no guarantee of future results. So on balance, we'd prefer rolling out and having a diversity of funds, even if you're going to go funds from different companies, so that you reduce your risk of as opposed to having all your money in one particular fund. Donna, anything?
Considering New Jersey credit status, are tax exempts okay? Again, we would go back to diversifying. You can look for funds that have an extra layer of protection with some insurance if you're not comfortable with New Jersey. But I think it's okay to own, to have some New Jersey credit risk in the portfolio, as long as it's balanced with other municipals.
Great, Donna. So at this point, we want to be respectful to everyone's time. We promised that we would give you the results of the poll, and we're going to now. Remember, the question was what you thought stocks would return over the next decade in terms of average annual return. 6% of you said under 3%. 63% of you said between 3 and 7%. 25% said 7 to 10, and only 6% over 10. So people were conservative there. Between 3 and 7 was what the majority thought would be the case. So we want to wrap up here. We will put this webinar online so you could take a look at it again. We're happy to give you a copy of the slide decks if you send us an email asking for that. And of course, at any point in time, we're here to help. If you'd like a complimentary meeting to discuss and review your finances and investments, do give us a shout. We're here in downtown Summit. We would love to meet with you. Again, thank you so much, Donna. Thank you so much for all you viewers.
Thank you, David.
Have a great afternoon.
Thanks, everyone.